Good morning, friends. Welcome to the session 3 of webinar on Indian accounting standards. Today, we have our eminent speakers, CA Achal Jain, CA Amit Jain, and CA Parveen Kumar. So Achal would be taking up Ind AS 103, and I request Achal to kindly take through the standard. Thanks a lot.
Thanks, Ms. Rangwali, and thanks to all of you for joining this session. And apologies for starting this session a bit late due to some technical glitch. Before I start the session, I'll just quickly introduce myself. I am a chartered accountant and I've been involved in IFRS and Ind AS implementation project over the years. I've worked with big four firms in the past for around 12 to 13 years, and currently I'm also getting some opportunities to associate with the ICAI Accounting Standard Board in respect of some seminars. That's why you see me over here. Yeah. And without spending too much time on this, I'll just now start with this session on Ind AS 103, which is about business combinations. I would say a very, very important standard and very, very relevant standard in Indian scenario, because in the past few years, we have seen how the things have evolved in terms of the acquisitions, not only by multinational companies, but also by the Indian companies. So these days, acquisitions and all these things have become so common for expanding the business. And that is where this standard on business combination becomes very relevant, because this standard is all about accounting in relation to the acquisitions of business. This standard, unlike what we have under Indian GAAP, has a larger perspective, means in terms of its coverage, it deals with any sort of acquisition of business, which is not really there under Indian GAAP. Secondly, this standard also talks about an accounting requirement, which is significantly different from what we currently do under Indian GAAP. Yeah. Now, in respect of this standard, couple of things are very important. One, that is about identification of a business, and second is about getting the control over that business. So that means if we have to call any acquisition or any transaction to be falling under Ind AS 103, these two things are mandatory. Means, first of all, there should be a business which is getting acquired. And in respect of that acquisition, we should be able to establish control of the acquirer. Because if the control is missing over the acquirer, then it will not get covered under Ind AS 103. Now, talking about control, first of all, what is control? Control means unilateral control. And for the purposes of detailed understanding of control, we go to Ind AS 110, that is about consolidated financial statements, wherein it is established how the control can be there over the acquiring. Ind AS 110 talks about three requirements. Means for establishing unilateral control, there should be three criteria which need to be analyzed, on the basis of which we can say, yes, there is a control over the acquiring. First, that is to have power over the investee. Means acquirer should have power over the investee, which could be through a contract, which could be through the voting right in terms of the majority percentage, or which could be through various other forms, and which is, unlike under Indian GAAP, not only dependent on the percentage shareholding. Because even through a contract, and even we can say with less than 50% of the voting rights of the acquiree, control can be established. Second criteria is about exposure or exposure towards the variable returns of the investee. Means the investor should be exposed to variable returns of the investee. If he is exposed, then it's fine. If the exposure to the variable returns of the investee is not there, then it cannot be said to be. And third is about marrying these two terms. Means through the power which the investor has, investors should be able to influence the variable returns of the investee. So if the investor is able to influence the variable returns of the investee, then it is considered to be one of the criteria which is further met. And if all of these three conditions are fulfilled, then the control is said to be established. Next is about identification of a business. Now, what is a business? Business, as per the standard, comprises of three items, or you can say three components. One, that is about input. Second, that is about process. And third, that is about output. So in case we have all of these three ingredients available, only then the business can be said to be there. If any of these component is missing, then the business is not considered to be there. Yeah. Now, what can be input for a business? For a business, people can be the input, or we can say the tangible or intangible assets can be the inputs. And these inputs, along with some processes, should be capable of generating some output. Because if the process is not there through which this input can be converted into the output, then once again, it cannot be said to be a situation of having a business. Now, at times, there may be a situation wherein output is missing. For example, if we talk about development stage companies or companies which are into initial stages, in those cases, output may or may not be there. Because in those stages, primarily, it will be input or the processes which will be going on. Even in those cases, standard says that the business can be considered to be falling under the criteria of Ind AS 103. However, if any of these two are missing, means if the input is missing or if the process is missing, then we cannot say that the business exists. Means without input, business can be said to be existing, but without input or process, business cannot be said to be existing. Then the standard has added further requirements in respect of testing of this business. If all of those requirements are established and we are in a situation wherein we can say that the business exists, then we can just move further on this criteria and we can just say that yes, there is a business which has been acquired and on which control has been established and which will then fall under the purview of Ind AS 103. Yeah. Now, once the business is established, once the control is established, then the next criteria is to get into assessment of certain requirements related to accounting to be done under Ind AS 103. Under Ind AS 103, the accounting that we follow is called as acquisition accounting. Now, in respect of this acquisition accounting, certain concepts or certain principles again we need to understand. First, that is about identifying the acquirer. Second is about identifying the acquisition date. Third, that is about the purchase consideration. And fourth is to get into the actual accounting under acquisition. So now we'll move on to understanding of all of these concepts so that then we get on to the understanding of acquisition accounting. Now, what is this acquirer, or who is this acquirer, and how do we really establish that an acquirer, which we see in the legal terms, is actually the acquirer and not somebody else? Now, if in the common parlance or in general terms, we'll see acquirer will generally be the person who is paying purchase consideration for acquiring the business. Acquirer will generally be the person who is getting control over the acquiry, which can be established through certain factors or certain situations. So maybe out of the two parties, so let's suppose there are two companies. A Limited has acquired the business of B Limited. In return for this, A Limited has paid, say, cash to B Limited amounting to 20 crores. So this is one of the ways through which we can check, yes, A is the party which is acquiring the business of B. Or we can say A has issued its share capital, or A has issued its shares in the form of purchase consideration for acquiring the business of B. This can be another way through which we can track, or we can just identify that yes, it's A who is the acquirer and not B. Now, conceptually, if we have to understand around the identification of the acquirer, the most important thing that we need to always check is about the control again. Once again, in respect of identification of the acquirer, what we need to check is whether the acquirer, or out of these two parties which are involved in a business combination or which are involved in acquisition of a business, which party is getting control over the other party. Because whichever party will be getting control over the other party in terms of its business will be said to be having the control, and therefore will be considered to be the acquirer for the purposes of accounting under business combination. Now this is important aspect because at times we get to see that a party who is the legal acquirer may not really be the acquirer, maybe an acquiree for the accounting purposes, which will not be there in most of the cases, but in certain cases those situations may also arise. So that's why it's very, very important to establish control over there once again, so that we are able to track the acquirer. Yeah. Next aspect around business combination, and I would say one of the most typical requirement in case of business combination, which is generally observed, happens to be the identification of identification of the acquisition date. Now, in a business combination, identification of acquisition date is the most important thing. Let's understand this once again with the help of an example, and then let's understand through various events which may take place. See, if the business has to be acquired, it cannot really happen within a day or within few days. Generally, this acquisition takes long period of time. It generally runs into months, wherein a lot of events will take place. So we can also look at some of those events to understand about this. Say for example, on 1st of April, board of the company, or we can say the company which plans to do the acquisition, has approved acquisition of another business. Means the board approval is there for acquisition of a business. Say on 31st of May of the same year, the company has signed a legal sale agreement with the acquiree. Then say after 15 days, say on 15th of June, purchase consideration has been paid by the acquirer to the acquiree. Let's suppose after 15 days, say on 30th June, after paying the purchase consideration, acquirer has got its representation on the board of directors in a way that now acquirer has got control over the acquiree. Yeah. So there are 4 events now. If we look at all of these 4 events, they would indicate as if the business is getting acquired. Now, in respect of these events, one point of confusion which generally needs to be assessed is that which date should we consider as the date of the acquisition? Means on which date we'll say that yes, it's the acquisition date on which acquisition accounting has to be done. Now, once again, for the purposes of assessment of the date of acquisition, we need to understand that date on which control is established means the date on which acquirer gets the control over the acquiry, because that date will be considered to be the date of acquisition. And this date is important because on the date of acquisition accounting is required to be done. Now, in most of the business acquisitions, another event is generally planned, and that is about approval of regulatory authority, or you can say NCLT, or which we commonly call as court approval. Now, once again, let's say there is another date in respect of the events that we discussed. Say the court approval in respect of this acquisition of the business was received on 31st of July. Now, once again, for us to assess that what will be the date on which this business combination accounting will have to happen, we'll have to consider this approval date from the court. Because whenever we receive any approval from the regulatory authority, we need to once again establish and understand over there that whether approval to be received from such regulatory authority was substantive in nature or not. Because if that approval is considered to be substantive in nature, means we are not sure whether this approval will be received or not, or even if this approval is received, that may significantly change various terms attached to the acquisition, and which is not really within the control of either of the parties. Then we will have to wait till the time we receive that regulatory authority approval, and that is considered to be substantive approval from the regulatory authority, or we can say that is considered to be a substantive condition which has to be fulfilled before we get onto this accounting. However, if this is not substantive and it is more of administrative means something which is a time arrangement, and the approval will also not require any significant changes. Those will be only minor changes, even if they arise in terms of the acquisitions. Then those are not going to be required to be factored in, because that is more of administrative, which is more likely going to happen. Yeah. So whenever we have this date of acquisition, on that date we should be able to establish control plus this condition of regulatory approval, wherein we should be substantive. Yeah. Next aspect that we need to consider is about the purchase consideration. Now, for the purposes of purchase consideration, we can have our purchase could be in the form of cash paid by the acquirer. Purchase consideration could be in the form of any instrument issued by acquirer to the acquirer. For the purpose do acquisition on the basis of this purchase, if becomes I think there was again some net Yeah. Okay, so we were talking about the purchase consideration. On the basis of this purchase consideration, goodwill determined. Now, this purchase consideration, sorry, I'm unable to hear you. Okay. Is it better now? Hi, so we'll just purchase Hey, once again, I'll just apologize for.
Apologies from our side. Actually, there's a network issue which is being sorted out, and Achal would be taking up the session now.
Yeah, sure. So we're discussing about the purchase consideration. Purchase consideration impacts the determination of goodwill. So that's why this is another very important aspect which has to be considered. The purchase consideration, as we discussed, could be in various forms, in the form of cash or the equity which is transferred from the acquiree to the acquirer. Along with this, there could be a consideration which may be deferred. So it's not necessary that the consideration is paid in one go or at the time of acquisition itself. At times, consideration is deferred, wherein the consideration may be paid over a period of 2 years or over a period of 3 years. If that is the case, that consideration is also required to be incorporated while computing the purchase consideration on the basis of which goodwill is determined. Another type of consideration which is required to be included is called as contingent consideration. Now, what is contingent consideration? Consideration which is contingent upon something. And this is again very commonly seen in case of acquisitions. For example, let's suppose acquirer and acquiree agree on a term wherein if the profitability of the business after the date of acquisition, let's suppose say improves by 15% within next 3 years, then the acquirer is required to pay some more consideration to the acquirer. Now this is something which is not really known today, and which will be dependent on the happening of this event, and which is not within the control of both the parties. This is called as contingent consideration. So the standard requires inclusion of this contingent consideration also at fair value while determining goodwill or capital reserve on the date of acquisition. Yeah. Now, along with this purchase consideration, next aspect that we need to consider for the purposes of goodwill computation is called as fair valuation of the net identifiable assets. Now, what are those net identifiable assets? Acquirer will be acquiring certain assets from the acquiree, and will also be assuming certain liabilities of the acquiree. Now, these assets and liabilities of the acquiree are also required to be fair valued by the acquirer on the date of acquisition for the purposes of computing goodwill or capital reserve. And on these assets or liabilities which will be fair valued, deferred tax implications are also required to be analyzed. So there could be a deferred tax impact on this, and that also needs to be incorporated goodwill or capital purchase on the date of acquisition. Another very important aspect which one has to consider while computing goodwill or capital reserve happens to be the identification of intangible assets. Now this is again, I would say, a very important area. Identification of intangible assets requires that whichever acquiree has been acquired or whichever business has been acquired, it may happen that this business has got certain intangible assets, but which were not recognized in the books of the acquiree. Why? Because they did not meet the criteria of intangible assets to be recognized in the books of standalone financial statements of the in the books of the acquiree, means in the standalone financial statements of the acquiree. For example, if we talk about self-generated intangible assets, they cannot be recognized in the books of acquiree. But when it comes to the acquisition, then of course acquirer must have paid something for that, because whenever acquirer is paying something, whatever purchase consideration is flowing from acquirer to the acquiree, that must be for various things which are getting acquired. That is not limited to assets and liabilities which are recognized in the books of acquiree. That will also include, a component of it will also include those intangible assets. For example, if the acquiree has got, say, long-term customer contracts which will have a value to the business even after the business is acquired. If we, let's suppose, talk about customer relationship which the acquiree has built over the years, again having a value to the business, and this is why acquirer is paying money to the acquiree. So that's why some portion of that purchase consideration pertains to those intangible assets. But because those intangible assets are not really recognized in the books of the acquiree, therefore at the time of acquisition, those intangible assets are also required to be identified first of all, and then recognized and measured at their fair values. Yeah, so this is again an important aspect, because generally it's seen that it's a complicated exercise. It's not very easy to identify the intangible assets, or even if the intangible assets are identified, it's difficult to measure them. And let's understand the implication. If for some reason we don't identify any intangible asset which exists in relation to the acquiree, then what will happen? The resultant amount goes to the goodwill, because goodwill is a balancing figure. So from the total consideration, we will we will reduce the value of identifiable assets. Let's suppose total value of goodwill is 1000, from which we reduce net identifiable assets, say 700. So 300 becomes goodwill. Now let's suppose 100 also pertains to intangible assets. And if that is not identified, so what is the implication? Those intangible assets have got subsumed with goodwill, which should not be done, because goodwill is a fictitious asset. And because goodwill is a balancing figure, that's why it will automatically subsume all of those intangible assets, which should not be done. And that's why this is another very important area which one has to consider at the time of acquisition accounting. Now, as we discussed, that for the purposes of computation of goodwill or capital reserve, fair valuation is required to be done in respect of all the assets or liabilities which are acquired, including the intangible assets, and the purchase consideration is also required to be assessed. To this principle, there are certain exceptions. Means there are certain items which will not be recognized at fair value. So I'll just move on to those exceptions now. Now, what are these exceptions? In relation to these items, which we are calling as exceptions, either their recognition will not be done or may not be done at the time of business combination accounting, or we can say at the time of this acquisition accounting, or if that is done, that will really be done as per the principles of acquisition accounting. That means that may not really be done as per fair values. So let's understand some of those items as to how they will really work. Contingent liabilities. Now, contingent liabilities are driven by the principles from Ind AS 37. Now, contingent liabilities could be of various types as the standard describes them. Some of the contingent liabilities could be possible one, means the possible obligations. Possible obligation means which may or may not arise. And liabilities could be the one which are other than possible, but which were not measurable. Now, in this respect, when the business combination accounting is required to be done, therein the contingent liabilities which are other than possible obligations are also required to be considered at their fair values if those are measurable. Similarly, if we look at some other items like deferred tax, so we discussed that deferred tax is required to be recognized at the time of business combination accounting. And how do we recognize deferred tax? Using the principles of Ind AS 12. We are not considering deferred tax at their fair values. So that's why we say that this is once again an exception to this principle. If we once again look at one more item, assets held for sale. Now, assets held for sale are required to be recognized as per the requirements of Ind AS 105, which says that assets held for sale should be measured at cost or fair value less cost to sell. It's not really the fair value, it's fair value less cost to sell. So because the cost to sell is reduced from the fair value, so that's why once again it becomes an exception to the principles of the fair values which we are adopting at the time of acquisition accounting. Another item which may be relevant for the purposes of business combination accounting could be the reacquired rights. Now, this could also be on the basis of the existing relationship between the acquirer and the acquiree. Say, for example, before the acquisition, acquirer had given certain licenses or certain rights to the acquiree. And after the acquisition, what is happening? These are getting acquired by the acquirer. So these are sort of reacquired. Now, when those reacquired rights are received by the acquirer from the acquiree, the fair valuation is done on the basis of the balance life of those reacquired rights. But if we get on the fair valuation principles, then the life will not really be the balanced life. It may also involve consideration of the renewal right or the renewable life or the life which will get increased after its renewal, and because of which its fair valuation may change. But when we follow this business combination accounting, such renewal lives are not required to be considered, and that's why this once again becomes an exception to the principle of business combination accounting. Okay, yeah. And with all of these exceptions related to the recognition and the measurement that we have talked about, we compute the goodwill or the capital reserve. Now, as around this goodwill or capital reserve that we compute, now this goodwill may at times be positive or negative. This goodwill may at times be positive or negative. If the goodwill is positive, it's fine. But if the goodwill is negative, then this becomes capital reserve. And that is also a very special situation, which is called as bargain purchase gain. Bargain purchase gain means a situation wherein the value of assets acquired or the net assets acquired is higher than the purchase consideration paid, which should be very, very rarely done, or which is very, very rarely seen. Standard also considers this aspect. Standard also says that generally bargain purchase gain should not arise. Generally, it should be a situation of positive goodwill. But in case we get into a situation of bargain purchase gain, or we get into a situation wherein we are seeing goodwill is becoming negative, then the standard requires that we should reconfirm this entire computation of goodwill, which is again very commonly called as purchase price allocation exercise. And if after sort of after confirming that exercise, or after just going through each and every aspect, we once again see that it's a bargain purchase, then it's fine. Yeah. So let's now quickly understand how is this goodwill computed. Now, for the purposes of computation of goodwill, we will have purchase consideration, which is paid by acquirer to the acquiree. And in case the acquirer has been acquired in stages, means let's suppose initially acquirer acquired 20% of the acquiree, then the acquirer acquired 40% of the acquiree. After acquisition of another 40%, acquirer got 60% in total. So that is when the control got established. Now at that point of time, when the control got established, purchase consideration would have been paid for 40%. But the consideration which was paid for 20%, or that stake due to which it eventually became 60% later on, is called as previously held equity interest. At the time of computing goodwill, that previously held equity interest is also required to be considered at fair value on the date of acquisition. Plus, NCI is also required to be considered. Now, what will be the NCI? In our example, as we discussed, we acquired 60%. 40% belongs to other parties, which under Indian GAAP is called as minority interest. That is called as NCI, non-controlling interest. Now, this NCI is also required to be considered while computing goodwill. But for the computation of NCI, two options are available, or we can say two methods are available, and any of those methods can be chosen. So there's no preference of the standard around this. One, this NCI can be measured at its fair value, means we just compute the fair value of the NCI and take that fair value of the NCI as the value for the purposes of computation of goodwill, or we can compute the proportionate share of NCI towards the net identifiable asset. Value of net identifiable assets is 1 crore. So the 40% NCI is the share of NCI. So share of NCI is 40%. So 40% of 1 crore means 40 lakh will be the value of NCI. Standard says that either of these options can be availed. But when the NCI value will change, or when either of these methods will be availed, because of the differences in the values of NCI, what will happen? The value of goodwill will change. So that means it's not necessary that the value of goodwill should be same using these two methods or using these two valuation criteria of NCI. It's okay if we have two different goodwill amounts, and that will be required to be disclosed. One, when the disclosures around business combination accounting will be given, and second, the company will also disclose this in the form of their accounting policy. Yeah. Now, from the combination or from the total of these three consideration, NCI and this fair valuation of previously held equity interest, we are required to reduce the net identifiable assets or the net assets acquired, which again would have been taken at their fair values, with certain exceptions as we discussed, and which will also include the intangible assets which may not have been identified earlier and which are required to be identified at that point of time. And this results in goodwill. And in case this computation results in negative goodwill, that will become capital reserve. If we check that yes, it's becoming negative goodwill, means we have sort of reconfirmed, then the standard says that we can take it to equity routing through OCI. But if we are not getting that reassurance, or we are not really sure about that bargain purchase gain, then the standard says that we should directly take it to equity. Okay, yeah. So this is how we compute goodwill, and this is the primary exercise which is required to be done at the time of business combination. Now, this business combination accounting that we have discussed will only be done on the date of acquisition, and after the date of acquisition, consolidation will start as per Ind AS 110. Yeah, so another question which may come to our mind is that when do we do this business combination accounting? On the date of the acquisition, or can we do this at the year end, or can we do this at any point of time during the year? Now, in this respect, the accounting requirement which one has to follow has to be as of the date of the acquisition. Now, on this point, standard also gives us one leeway. Now, as we discussed, that acquisition of a business is not a very simple exercise. It's a complicated exercise. It's a time-consuming exercise. And even after acquisition of business, its settlement, means overall process or overall transition process of acquiring the acquiree from another entity takes time, takes a lot of time. And a lot of information, or maybe some of the information related to this business combination accounting, may not be easily available. It may be practically very, very difficult to have all of those information with the acquirer by the time acquirer is closing its financial statements. And therefore, standard gives us one provision, which is called as measurement period, or we can say provisional accounting. Now, what is this provisional accounting? Standard says that in case some of the information could not be received, or it was not practically possible to have some of the information related to acquisition accounting by the time company closed its financial statements, means the acquirer closed its financial statements, then in respect of that, provisional accounting should be done within that financial year. Means accounting should be done, but that should be provisional. And after that, means in the next financial year, that accounting should be finalized when that information is available. And this is okay. And it doesn't mean we can just, use this option every time and we can just defer our accounting for 1 year as the standard suggests. Standard says only when it is practically not possible to receive such information, then it is required to be done. Otherwise, it should not be done like this. Now, what is this measurement period? It starts from the date of acquisition up to 1 year. Means if the date of acquisition was 1st of February 2020, so it will be 1st of February 2021. Okay, that is when the measurement period ends. And within the measurement period, the accounting which was done on provisional basis should be finalized by the acquirer. Secondly, any changes that arise due to this finalization of the provisional accounting in the subsequent year will also have to be incorporated in the financial statements, and which may also require restatement of the comparative amounts. Means the restatement of the amounts in the financial statements of the comparative year, and that is all right. The important aspect once again in this case will be the disclosures. In the disclosures, the fact that the provisional accounting has been done, and in the next financial year, the fact that the provisional accounting has been updated is required to be properly given in the notes to accounts. Okay, yeah. Now, as around this measurement period, let's suppose if the accounting which was done on provisional basis gets finalized after the measurement period is over, then it will not get covered within the purview of Ind AS 103. So Ind AS 103 only gives us 1 year from the date of acquisition, and 1 year will have to be considered from the date of acquisition. So we cannot say that if 1st of February 2020 was the acquisition date, we cannot say that if 1st of February 2020 was the acquisition date, so that means we will count it as 1 year from the end of 31st March 20 up to 31st March 21. No, it has to be up to 1st of February 2021 only. All right, yeah. So this is another important thing which is practically used by the companies while they finalize their accounting, and in such situation wherein they are not able to wrap up their accounting requirements. Yeah. Now moving on to next type of business combination, and which is called as common control business combination transaction. So far, whatever we have discussed about business combination accounting was in relation to all those business combinations which were not in the nature of common control transactions. Because for common control transactions, a different accounting requirement has been suggested by the standard, and which does not exist under IFRS. This is something which has been incorporated only under Ind AS 103. So let's now quickly understand about this common control business combination. What do we mean by this? Common control business combination means that the acquirer has acquired the acquiree within a group, and the acquiree was controlled before the acquisition and after the acquisition by the same company or by the same entity or by the same person. Means the ultimate control on the acquiree before the acquisition and after the acquisition remains same. This has not changed, and this control is not transitory. So you can just see this diagram. Let's suppose E Limited in our situation, which is controlled by B, is now acquired by C Limited. Let's suppose C Limited now acquires E Limited. Now, if we look at E Limited before the acquisition, it was ultimately controlled by A Limited, because A Limited controls both B and C. And if we see C Limited, that is again controlled by A. So after the acquisition of E Limited by C Limited, the ultimate controlling party remains A Limited. This has again not changed. This has remained same. And if this ultimate control with A is not transitory in nature, if it's not transitory in nature, then this is considered to be a business combination transaction which is under common control, because we are saying the control is common both before and after the acquisition. Yeah. Whenever we have any common control business combination transaction, therein the standard says that the accounting should be done using pooling of interest method. Means therein the fair valuation will not be used. Therein the book values of the acquiree will be used. The reserves of the acquiree which will move to acquirer, they will reserve their identity. So they will maintain their identity before the acquisition and after the acquisition. And in that case, no goodwill is generated. So no goodwill will be recognized in case of common control transaction. So any impact that arises will go to reserves, but the goodwill doesn't arise in these situations. Okay, yeah. And as we have discussed that for this common control business combination transaction, currently there's no guidance under IFRS, but this has been introduced under Ind AS 103. All right, yeah. So with this, we have talked about business combinations of two types, and another important aspect which I'll just quickly touch upon before I just wrap up my session could be in relation to asset acquisition. Whenever we will assess whether a transaction is a transaction of a business and we are getting control or not, then it will fall under Ind AS 103. But at times it may happen that the transaction has occurred, but it's not covering the business. So if it's not covering the business and we have actually acquired assets, then it will become asset acquisition. Then it will become asset acquisition, for which accounting requirement will have to be done as per Ind AS 16, which is in relation to PPE or intangible assets or any other asset. Yeah? And which will again be different from what we see under Ind AS 103. All right, yeah. So with this, what I can do is, considering the time that we are approaching, I'll just end my session over here. And I would just like to thank all of you for your time for this session. And I understand that C. Amit Jain is going to take your next session. So I'll just hand over this session now to C. Amit Jain.
Thank you, Achal. Good afternoon to all of you. I hope you guys are doing well. Let me share my screen. I hope the screen is visible to all of you guys. So let me introduce myself first. I'm Amit Jain. I'm working as a director in EY. I'm having around 8 to 10 years of experience in the implementation of IFRS and Ind AS. I have assisted lots of companies, lots of big corporates in India for the implementation in IFRS and Ind AS. Right? So today we have a session on Ind AS 12. Ind AS 12 deals with income tax. So before moving on Ind AS 12, I would just provide you the brief background about the standard. So under Indian GAAP, we have AS 22, which deals with the deferred tax. Right? Under IFRS, we have IAS 12, which deals with income tax. And similarly, we have under Ind AS 12, which deals with income tax and deferred tax. Right? So guys, before moving further, so we should link these standards with the Indian GAAP as well, because largely the concept of deferred tax is nothing but same as Indian GAAP, which we have read in our past. Right? So if I talk about the deferred tax is nothing but a notional accounting entry, right? Due to which we will reconcile our tax rate as per income tax and the books, right? This is a very, very important aspect. This is a very, very important topic because it is applicable to all the companies in India, right? Because no exemption and the exception has been provided in the standard, And since this standard is applicable to all companies, so every company has to evaluate the impact of income tax and deferred tax in its books of accounts when they are preparing their financial statements. Third point is this standard is applicable to all the companies retrospectively, right? All the standard under IFRS as well as under Ind AS are applicable retrospectively unless and until any exemption, transition exemption provided under Ind AS 101 or within the respective standard. So if we look at Ind AS 115 and Ind AS 116, some sort of transition exemption have been provided into that particular standard when they have introduced in India in the last couple of years. And some exemption have already been captured under Ind AS 101 in respect of the transition methodology. So in respect of Ind AS 12, there is no exemption or transition exemption provided within the standard or within Ind AS 101, and hence this standard will be applicable retrospectively. Right. So with this basic background, guys, let's start the standard. And if there is any doubt which you guys are having during the course of session in respect of any matter on income tax and Ind AS 12 and on income tax and deferred tax, you can raise those queries through the link or the chat box provided by the institute. Right, guys. So with this basic background, let's start with the standard Ind AS 12. So this is the agenda which we are going to cover. One is the objective. That means we need to understand why we are reading the standard. What is the use of having deferred tax in the books of accounts? Right? Why we are recognizing deferred tax in my financial statement? What is the scope of this standard? So we need to understand on which aspect this standard is applicable. Then we will understand what is a deferred tax. Right? We know income tax, but this is a new terminology, or I would say it's an old terminology which we have already read under Ind AS 22. But again, we will discuss what is deferred tax. Right? Then we will also discuss about book base and tax base. The concept of recognizing deferred tax or the computation of deferred tax has got changed from Indian GAAP to Ind AS. Under Indian GAAP, we follow income approach, but under Ind AS, we follow balance sheet approach. Right? So this is a significant change which has arisen, and there are certain items on which we never recognize deferred tax under Indian GAAP, but we recognize deferred tax under IFRS or under Ind AS. So we need to understand what is a book base, what is a tax base of a particular item due to which we can recognize deferred tax on that. Then we will also study about recognition of deferred tax asset and deferred tax liability. What are the scenarios and what are the items on which we create a deferred tax asset, and what are the items on which we create a deferred tax liability. After that, we will also understand what are the steps in computation of a deferred tax, whether it is a DTA or whether it is a DTL. Subsequent to that, we will also understand offsetting of DTA and DTL. In this particular section, we will understand whether we can set off the deferred tax asset with a deferred tax liability or a deferred tax liability with deferred tax assets. And what will happen when a company go for a consolidation? So if the company has a worldwide presence, let's say the company is having a subsidiary in US and the company is also having a subsidiary in Australia. So the deferred tax asset which is arising in the US subsidiary and the deferred tax liability which is arising in the Australian subsidiary, whether the company in India who is a holding company can offset those deferred tax asset and deferred tax liability pertaining to different jurisdiction. Right? After that, we will also understand the recognition of deferred tax in certain complex areas, for example, compound financial instrument. Right, in this particular aspect, I will briefly touch upon what is compound financial instrument. I hope you guys must have read IFRS 9 or Ind AS 109 and Ind AS 32 as well, in which the compound financial instrument have been captured. But we will talk about what is the implication of deferred tax on compound financial instrument, which we have read under Ind AS 32 and Ind AS 109. Then we will also talk about the tax holiday period. So how the deferred tax is going to be recognized in case of tax holiday period. After that, we will understand if the company is having a significant losses, unused tax credit, then how the deferred tax is going to be recognized in that scenario. In the last session, Achal has raised a point, or Achal has discussed a couple of matters in respect of the goodwill on the business combination. Right? So we will also understand how the deferred tax will impact goodwill which has arisen in case of the business combination. Then we will talk about the first time adoption. and disclosures, and finally we will also discuss what is the gap difference between Indian GAAP and Ind AS in respect of Ind AS 12 versus Ind AS 22 on deferred tax. So this is the broad agenda, guys, which we are going to discuss, right? So let's start our sessions on deferred tax and income tax, which is Ind AS 12. Correct. So first of all, objective. Why we are reading the standard? What is the use of having a standard specifically on income tax? Considering the fact we have the broad income tax available in India, which is a income tax law 1961 in India. Why we are reading this again income tax here? So the objective of having this standard is that how to recognize income tax on the items which are going to recognize in P&L, how to recognize tax for the items which are going to recognize in OCI, and how to recognize tax effect for the items which are going to recognize in equity. So that means, guys, we are going to understand that there are certain items which gets recognized in P&L. So how to consider the effect of tax on those items which are going to recognize in income statement, how to recognize the tax impact of the items which are going to recognize in OCI, because there are certain items which gets recognized in OCI which doesn't get recognized in P&L, and there are certain items which gets recognized in equity. It may possible that we recognize a deferred tax on those items which get recognized in equity, right? Second objective of the standard is to provide us the guidance how to present the income tax and deferred tax, how to disclose those items, what are the key disclosure needs to be given in the financial statement in respect of the income tax and deferred tax. The another objective of the standard is to provide the guidance how the deferred tax is to be created if the company has a strong history of having a significant losses or tax credit, right? So we are using the word, or the standard is using the word, the tax credit. What does it mean? Tax credit means like a minimum alternative tax in Indian scenario. So again, this is a gap difference from Indian GAAP to Ind AS. Under Indian GAAP, minimum alternative tax we recognize as a part of the loans and advances, which we are going to get the benefit in the future. But that minimum alternative tax is considered to be a part of deferred tax, and hence it creates a gap difference between Indian GAAP and Ind AS. This we will also cover when we will talk about the gap difference between AS 22 and Ind AS 12. Another objective could be temporary difference. Under Indian GAAP, we talk about the timing difference, but the wording of the timing difference has got changed under Ind AS. Under Indian GAAP, we talked about two type of difference between books and tax. We are just reconciling two books, which is books. Books means financial statement, which we are preparing as per Schedule 3 of MCA, right? And tax means the books which we are preparing for the tax computation purpose, which is income tax computation, which is to be created as per the applicable law of income tax and ICDS, income computation and disclosure standard. So what is the temporary difference and what is the timing difference? Indian GAAP talks about the timing difference and permanent difference, but Ind AS only talks about the temporary difference. What is the difference between that? We will also understand during the course of this session. Correct. Then we will talk about the recovery and settlement of the carrying amount of assets and liabilities, and finally how the deferred tax assets and liabilities to be recognized in case of business combination. So that is the whole objective, that how to recognize the deferred tax asset and liability in the financial statement of any company. Correct, guys? Then we have the scope, that on which item this standard is applicable. As the name of the standard suggests, income tax. So this standard is only applicable to income tax. It is not applicable to any indirect tax. Correct? Like GST, this standard is not applicable, or any other taxes, this standard is not applicable. This standard is only applicable to the income tax. Now, income tax includes a domestic tax or any tax paid by the company in a foreign country that gets covered within this chapter, or any tax which has been deducted as a withholding tax, right? Income tax which has been deducted as a withholding tax, then it will get also applicable to those kind of taxes. So in a nutshell, it is applicable to an income tax, maybe a domestic tax, maybe a foreign tax, maybe a withholding tax. This standard is not applicable to the government grant. That means any grant received by the company from the government, this standard is not applicable because we have a separate standard on the government grant, which is Ind AS 20. This standard is also not applicable on the investment tax credit. Now the question arises, what is investment tax credit? So generally it happens if a company has made an investment in a particular area, right? So the portion of that investment is allowed as a deduction from the profit while computing the taxable income, right? So this standard is also not applicable on the investment tax credit. But any temporary difference which is arising because of the government grant or income tax credit between the books and tax, then that on that particular temporary difference we need to compute the deferred tax assets and liabilities, right? So in a nutshell, guys, the scope of the standard is very clear. It is only applicable to the income tax and not any other tax. Income tax includes domestic tax, foreign tax, withholding tax. Correct? So this is brief about the scope and the objective of the standard. Now we need to understand what is a deferred tax. So in deferred tax, there are two things. One is a deferred tax asset, one is a deferred tax liability, right? So I will come back to this particular point. What is a deferred tax asset? What is a deferred tax liability? Let's understand how do we need to present this deferred tax in my P&L, how it actually how the people, how the users of the financial statement and how the preparer of the financial statement should prepare the P&L and present the deferred tax, right? If you guys can look at the screen, right, how the deferred tax is to be presented, we need to present the tax expense in my P&L, right? Within the tax expense there are three items. One is the current tax, second one is the tax pertaining to the prior years, and the third one is the deferred tax, right? And the total of these three components will become the income tax expense or total tax expense, right? So what comprises in the total income tax expense? One is the current tax, one is the tax income tax pertaining to prior years, and the deferred tax, right? So this is how we are going to present my deferred tax in the P&L. And the consequently the accounting entry will also be recognized in the balance sheet either as a deferred tax asset or as a deferred tax liability, but we will discuss that part in detail when we will discuss the disclosure aspect. Correct? Okay, now the question arises, what is the need of having a deferred tax in my books of accounts? What has happened due to which I need to create a deferred tax in my books of accounts? Right? If you are able to see on my screen, let me open the pointer as well. Okay, so I've created a small example here for the understanding of the deferred tax concept, guys. What I've done, I've taken the books as I've taken the numbers as per the books, that means as per the Companies Act books and as per tax. Correct? Let's say the revenue is 1 lakh rupees. Let's say the expense, there are only three expenses in a company. To understand this example, let's say the gratuity is 20,000 rupees, leave encashment is 10,000 rupees, and the bonus is again 10,000 rupees. So the profit before tax of the company is 60,000 rupees, and the rate of tax is 30%, right? So first I need to compute the current tax of the current year. How should I compute? For preparing the or for computing the current tax expense, I need to go back to Income Tax Act 1961. I need to go back to ICDS, Income Computation Disclosure Standard, issued by the CBDT couple of years back, right? And basis that I need to prepare the income tax computation, and on the basis of that I will get my current tax expense, right? So I need to take this revenue 1 lakh rupees and I will disallow these three expenses: gratuity, leave encashment, bonus. Why? Because as per the respective section 43B, the deduction shall be allowed only on the actual payment basis and not on the accrual basis. Under books, all these three expenses have been recognized on an accrual basis. And let's assume in a particular current year, nothing has been paid to the employee on account of gratuity, leave encashment, and bonus, and hence all these expenses will get disallowed under tax. So the taxable income will come out to be 1 lakh rupees under tax. And since the rate of tax is 30%, so I will get the current tax expense is only 30,000 rupees, right? And this 30,000 rupees will be created in my books of account as a current tax expense. So the company will recognize this 30,000 rupees as a current tax expense in its books of accounts, right guys? Now what will happen? Now look at this particular column as per the financial statement or as per the books. What has happened? The company has a profit before tax 60,000 rupees, tax rate is 30%, and current tax is 30,000, which is coming from the tax computation. Ideally, what should happen if the PBT is 60,000 rupees, multiply by 30%, which is 18,000, should be my tax expense. But in India or any other jurisdiction, every company or every organization has to compute the tax as per the tax act only, right? So since I have recognized the current tax expense, or the company has recognized the current tax expense of 30,000 rupees, this created a big mismatch between tax and books. If I compute the effective tax rate, which the company is actually paying to the government, is coming out to be 50%. And how I have computed? 30,000 rupees, which is the tax expense, divided by 60,000 rupees, which is the profit before tax, and it is actually coming out to 50%. That means company is actually ended up in paying 50% tax to the government while the tax rate is 30%, right? So this create a significant difference between the actual tax rate, which is 30%, and the effective tax rate, which is coming out to be 50%, right? And the delta of this 20% is nothing. The delta of this 20% is the same expenses which have not been allowed as a deduction under tax, right? So that is why the concept of deferred tax has arisen, and due to which the standard setter says that the company has to create a deferred tax. That means the benefit of this tax is going to be in future. The future benefit or future liability needs to be recognized in my today books of account, and that will be accounted as a deferred tax in my books of accounts, right? So by recognizing this 12,000 rupees, and how this 12,000 rupees has arisen, this has arisen nothing but a 30% on all the accumulated effect of these expenses which get disallowed under tax, right? And by doing this exercise, the profit after tax has come out to be 18,000 rupees. And now if I compute the mathematical equation, 18,000 divided by 60,000 rupees, I will get 30% as the actual tax rate. So the tax rate as per books and the tax rate as per tax has reconciled. So this is a very basic example to understand the basic concept of deferred tax. So deferred tax is nothing, my dear friend. It's a notional accounting entry which needs to be recognized in the books of accounts in order to reconcile the tax rate as per tax and the tax rate as per books. This is why the origin, or this is the region of the origin of deferred tax in the books of accounts. And this concept is same both as per Indian GAAP as well as under Ind AS. The only change is we need to compute the deferred tax not as per the P&L approach, but as per the balance sheet approach in Ind AS, which we will cover as a part of our discussion in the differences between these two caps. I hope the concept of the deferred tax must be clear to you guys, right? Now I will come back to my earlier slide, the deferred tax asset and a deferred tax liability, right? So in that particular example, we have understood that there are certain differences which will arise between books and taxes, right? And those differences are nothing but are called a temporary difference. So if you read this definition, temporary difference are the differences between the carrying amount of the assets or liability in the balance sheet and tax. So I would say this is nothing but a reconciling items between the books and tax. So in our existing example, gratuity is a temporary difference. In our example, leave encashment is a temporary difference. In our example, the bonus which the company has created is a temporary difference, right? So on those temporary difference, we need to create a deferred tax. Correct. Now the deferred tax is of two types, guys. One is deferred tax asset and the second one is deferred tax liability. Now we need to understand what is deferred tax asset and we need to understand what is deferred tax liability. Correct. So since the name of this item suggests it is an asset, that means I am getting some sort of benefit on account of tax in future, right? And the name of the deferred tax liability itself suggests that it is a liability. It means then in the future I need to pay some taxes. Let's go into the definition of what is deferred tax. Let's go into the definition of what is deferred tax liability. So if I look at the deferred tax asset, the standard says the deferred tax assets are the amount of income tax recoverable in the future period. So it means as the asset represents, the benefit is going to be available to the company in future. So deferred tax asset is nothing but an income tax recoverable in the future period, right? In respect of the deductible temporary difference. What is deductible temporary difference? That means temporary differences of two types. One is deductible and one is taxable, right? The example which we have quoted, gratuity, the benefit I'm going to have in the future, it becomes a deductible temporary difference, because in the future that gratuity I will avail the exemption or I will avail the allowances in the future. So that becomes deductible, but we will discuss this deductible and temporary difference separately in detail, right? So coming back to deferred tax asset, it is the amount of income tax recoverable in the future in respect of deductible temporary difference, in respect of unused losses. So if the company has a significant losses as per tax, I need to create a deferred tax on that, because in future if the company is having a profit, company will utilize that losses against that profit, and whatever the balance will company have, that will be eligible for taxes in the future. Deferred tax asset in respect of the carry forward of the unused tax credit. If the company is having a MAT credit, minimum alternative tax, that will become a deferred tax asset. This is a gap difference between AS 22 and Ind AS 12. Correct, guys? If I come to deferred tax liability are the amount of income tax payable in the future. That means company has to pay the taxes in the future. It is a liability. It is a future liability, right? On some temporary difference due to which the company is expected to recognize those liability in a today's world, in today's financial statement. That is what a deferred tax liability. So that means every organization will be having either a deferred tax asset or a deferred tax liability, right? So there is a proper disclosure needs to be given in the balance sheet. We will talk about that. And now I hope the concept, the basic understanding of deferred tax must be clear to you guys, right? Should we move forward? Okay. Temporary difference. So temporary difference are of two types. One is the taxable temporary difference and the second one is the deductible temporary difference, right? So taxable temporary difference will result in the taxable amount in determining the future profit and loss. That means taxable temporary difference, those differences which gets taxable in the tax in future periods. So that will result into the outflow of taxes in the future, due to which I will create a deferred tax liability in my books of accounts, in the company's books of accounts, in the today's financial statement. What are deductible temporary difference? Deductible temporary difference means the difference between books and taxes, right, which will get allowed as a deduction in the future period, right, which will be allowed as a deduction in the future period on which the company has to create a deferred tax asset, right? Let's understand what are the key examples of the deductible temporary difference and the taxable temporary difference. Okay, so for example, gratuity. So let's say the company recognizes a gratuity. Company has created a provision for gratuity in the current year, but the company has not paid any amount to any employee during the year because no employee has retired during the particular year. But in tax, that will get disallowed because of the applicability of section 43B, and it will be allowed only on the actual payment basis. So this will create a gap difference, or this will create a temporary difference, I would say, between the books and between the tax, for which the company will get the deduction in the future. And on this particular aspect, company should create a deferred tax in its books of accounts, or I would say company should create a deferred tax asset in its books of accounts. Similarly, leave encashment. So if the company has created a provision for leave encashment in its books of accounts, right? And the company has not paid any amount during the current year, the entire amount will get disallowed under tax because it will be allowed as a deduction. It will be allowed as a deduction only on the actual payment basis, right? So company is supposed to create a deferred tax asset on this leave encashment. Similarly, bonus. If the company has created a provision for bonus in its books of accounts, right, it will get disallowed because it will be allowed only on the actual payment basis, right? Therefore, this will resulting into a deferred tax asset. Another example could be depreciation on the PPE, right? So why there is a difference between a PPE under books and the PPE under tax? The difference arises because of the tax rate. So under books, we have to follow, or the companies have to follow Schedule 2 rates, MCA Schedule 2 rates, and the rates which have been prescribed by the MCA in the Schedule 2 itself. But for the tax, the company has to use the rate which have been prescribed under tax only. So due to the difference in the tax rate in the books and tax, this will create a difference in the book profit and the tax profit, right? So on the depreciation part, company is supposed to recognize a deferred tax. This depreciation may result into a deferred tax asset, and this depreciation may also result into a deferred tax liability. So if the book base is less than the tax base, we will also discuss what is the book base and what is the tax base. But here, if the carrying value of the PPE in the financial statement is less than the tax rate, then it resulted into a deferred tax asset. And but if the PPE value or the carrying value of the PPE in the books is more than the tax base, is more than the tax, then it result into a deferred tax liability. Correct? So this depreciation on the PPE or the PPE can be either a temporary deductible temporary difference or a taxable temporary difference. Another example could be provision for obsolescence of inventory. If the company has created a provision for obsolescence, right, and it will get disallowed under tax, then it will create a temporary difference on which deferred tax is supposed to be created. Similarly, a pre-incorporation expense. So if there is any pre-incorporation expense incurred by the company under Ind AS, that expense shall be charged to P&L in the same year. But under income tax, that will be allowed as an expense over the period of 5 years, and thereby it will create a temporary difference. And thus the company has to recognize a deferred tax on those temporary differences. So these could be the possible deductible temporary difference, guys. Right? If I talk about the taxable temporary difference, for example, fair valuation of the PPE. So under Ind AS, fair valuation of PPE is allowed, but under tax, the fair valuation is not allowed. It will be taxable once the company sell that PPE in the future. Right? So hence the fair valuation or the revaluation of the PPE resulting into a deferred tax. Interest accrued on the effective interest rate methodology. You guys must be aware of the fact that under Ind AS, any interest needs to be, if there is any interest needs to be computed, that needs to be computed basis a effective interest rate methodology. What is effective interest rate? It is nothing but a methodology in which interest is to be computed based on the cash flows and based on the IRR, which is internal rate of return. Right? Under Indian GAAP, we use the simple interest method, but under Ind AS, we use the effective interest rate methodology. Right? So if any interest needs to be accrued on the effective interest rate methodology, that is not allowed under tax, and hence it creates a temporary difference. Another example could be deferred tax in case of compound financial instrument. We will discuss the compound financial instrument, but it will result into a taxable temporary difference. And the depreciation on PP, which we have discussed in case of temporary. So depreciation results into a deductible temporary difference as well as a taxable temporary difference. So these are the some illustrative examples of the temporary difference which resulted into a deferred tax asset, which resulted into a deferred tax liability. Right, guys? So let's understand what is the accounting entry. Right? Let's understand what is the accounting entry of recording a deferred tax asset or recording a deferred tax liability. So if the company has to recognize the deferred tax asset, what should be the entry? Entry would be deferred tax asset to deferred tax income. Right? So this deferred tax asset will be recognized in the balance sheet, and it will not be discounted, and it will always be a non-current asset. It will always be a non-current asset. Deferred tax is not supposed to be bifurcated into a short term or long term, into a current as well as non-current. It is always a non-current item, right? And the deferred tax income, which is a P&L impact, it will be recognized in the P&L, and if it is a charge, it will again be recognized in the P&L within the tax expense section, as we discussed earlier. But suppose, let's say there is a company has recognized a deferred tax asset in a one particular year, and in the subsequent year there is a reversal of deferred tax. So what will happen? So company will account for the deferred tax reversal by doing the reverse accounting entry. For example, deferred tax expense will get recognized in the financial statement in the P&L, and the consequent impact will be deferred tax asset will get reduced, right? So this will be the accounting of deferred tax asset and the reversal of deferred tax asset. If I look at the deferred tax liability accounting, again, very simple accounting, expense side debit with the corresponding liability, that is a deferred tax expense to deferred tax liability. Again, this liability will be a non-current liability. There will be no bifurcation of short term and long term, right? I would like to provide some more insights in this respect of deferred tax bifurcation into current and non-current, or only a non-current. Under Ind AS, under Indian GAAP, and under IFRS, there is no concept of allocating a deferred tax asset or liability into a short-term or long term. It is always a non-current in nature. But when I look at the US GAAP, US GAAP provides a guidance that if you are creating a deferred tax on the item which has been classified as a short term, then it will be a short term deferred tax. If you are creating a deferred tax on a long term item, then it will be a case of long term deferred tax. But that concept only exists under US GAAP. That concept doesn't exist under IFRS. That concept doesn't exist under Indian GAAP, and that concept doesn't exist under Ind AS as well. Correct, guys? So what we have learned here is, so accounting entry of the deferred tax is, if there is an asset debit to income, right? If there is a liability, then liability credit expense debit, and if there is a reversal, we will pass the reverse accounting entry. These deferred tax will not supposed to be discounted. This is always a long term in nature, and this will be reviewed at the end of every year or at the end of every reporting period. So let's say the company is a listed company, so company will review the deferred tax at the end of each quarter, right? If the company is a private company and the company is preparing its accounts on an annual basis, right, then the company has to review this deferred tax on an annual basis. So this deferred tax needs to be reviewed on a reporting period basis. Correct, guys? Okay, let me move on. Now we need to understand what is a book base, and we need to understand what is a tax base. Okay, so so I have classified all the assets into two categories. One is a taxable asset, and the second one is a non-taxable asset. Again, I have classified the liability into two categories: deductible liability and non-deductible liability, right? What is the book base and what is the tax base, that we need to understand. Book base, in all the cases, book base is nothing, the value which we are arriving from my balance sheet. So let's say if I'm preparing the 31st March 21 accounts, right? If I'm preparing the 31st March 21 accounts for a company, the value which is appearing in the balance sheet of the company in respect of assets and liabilities, that will become a book base. So book base is nothing, guys. Book base is only a carrying value of the assets and liabilities appearing in the books of accounts. Now coming to the tax base, what is the tax base, right? So if you look at the non-taxable asset, so non-taxable asset means it has nothing to do in tax. For example, any item which has nothing to do in tax. For example, loan given. If I have given any loan, it has nothing to do in tax. I have given a loan of, let's say, 1 crore rupees. I will receive my loan of 1 crore rupees. It is a balance sheet to balance sheet item, right? So there will be no tax treatment in respect of that loan which I've given. So what is the carrying value? What is the tax base of that non-taxable asset? The same carrying value will be a tax base. Ideally, if I've given a loan of rupees 1 crore to Mr. A, right? Whether there is any disallowance under Income Tax Act? No, there is no disallowance under Income Tax Act. So ideally, I should not be computing deferred tax because there is no temporary difference. That is why I am saying if the carrying value or the tax base is if the carrying value is allowed or carrying value is considered as a tax base, then there will be no temporary difference and no deferred tax to be recognized, right? And if I look at the taxable asset, so amount deductible for tax purpose in the future shall be considered as a tax base. For example, PPE, property, plant and equipment. What is the carrying value? The value which is appearing in the books of accounts. What is the tax base? Tax base means the WDV of PPE computed as per income tax rate will be the tax base of taxable asset or tax base of PPE. Right, guys? Similarly, if I look at the liability side for non-deductible liability, let's say I've taken a loan from bank. Is there any disallowance or allowance under tax? No. So the carrying value of the loan will become the tax base, so that there is no temporary difference and there is no deferred tax. Correct? And if I look at the deductible liability, what is the book base? Carrying value is the book base, and what is the tax base? The carrying value minus any amount which is allowed as a deduction in the future, that shall be considered as a deduct tax base of the deductible liability. Right? Let's take a couple of examples to understand what is the tax base in case of taxable asset, in case of non-taxable asset, in case of deductible liability, and in case of non-deductible liability. Let me quickly move on. Okay. So entity A has an inventory with a carrying amount of rupees 1 lakh. So inventory. So first of all, inventory is there as at the reporting date and the carrying value is 1 lakh rupees. That means if the carrying value is 1 lakh rupees, it becomes a book base. It recovers the value of inventory through sale in a subsequent reporting period. The sale value is the economic benefit derived by the entity and is taxable. So that means in the future, this inventory is going to be sell off by the company, right? And what will happen? As per the matching principles, again this sale, the entity is entitled to deduct its cost. The cost is the carrying amount of the inventory, right? So the cost, what is the benefit which the company is going to get in respect of the inventory in future is only 1 lakh rupees as a cost of sales, right? So what is the book base? Book base is 1 lakh rupees. What is the tax base? Tax base becomes 1 lakh rupees because the company is going to have the deduction in the future as a cost of sale is 1 lakh rupees, right? And therefore the temporary difference will become 0 and there is no deferred tax needs to be recognized in case of inventory, right? This methodology is called a balance sheet approach, guys, where we will take the numbers from the balance sheet, which is a book base. We will also take the carrying value of the asset as per the tax, which becomes a tax base, and the difference is temporary difference, and on this temporary difference we are supposed to create a deferred tax. If it's 0, then the deferred tax will be 0. I hope you can understand what is book base, what is tax base in case of tax base asset. Let's move ahead. Let's take one more example. An entity has given a loan of rupees 1 lakh, which is a carrying amount. That means, let's say I have given a loan of rupees 1 lakh, right? And if I've given a loan of rupees 1 lakh, is there any allowances and disallowances under tax? Nothing in the tax, right? So what will happen? What is the tax base and what is the book base? So book base will be 1 lakh rupees because that is a carrying value. And what is the tax base? Tax base again 1 lakh rupees because it is a non-taxable asset. So the carrying value will become the tax base. And since the temporary difference is 0, then therefore there will be no deferred tax on this particular item. Correct? Okay, let's take an example of deductible liability, right? Deductible liability, that means the liability which is going to be deductible in the future under tax. Okay, let's take the example. Current liability includes bonus expense with a carrying amount of rupees 1 lakh. The related expense will be allowed as a deduction on the actual payment basis, right? So what is the book base of this bonus amount? Book base is 1 lakh rupees, which is nothing but a carrying amount. And what is the tax base? Tax base, what is the tax base? There will be no tax base, right? Because I'm going the deduction, I'm going to get the deduction under tax of rupees 1 lakh. And what is the formula written in the earlier slide? Carrying value minus the deduction. So 1 lakh minus 1 lakh is equal to 0, which becomes our tax base, and therefore temporary difference will be 1 lakh rupees, and I need to create a deferred tax, right? If I look at this example from the other way around, right? If I created a provision for bonus in my books of accounts, it will be allowed as a deduction in the future, but not in current year tax, right? So ideally it creates a temporary difference. Ideally I need to create a deferred tax as well, right? So that is what the concept is. If there is a difference, I need to create a deferred tax on that, right? And this is the backward working, that how should I compute the tax base. So there are two approaches basically to understand this concept. One is the balance sheet approach, one is the income approach. Income approach we use under Indian GAAP, balance sheet approach we use under Ind AS, right? So if we apply the logic by both the method, we will get the same results. The only difference is under Ind AS there are certain items which recognize in balance sheet and we need to create a deferred tax on that, but those item doesn't recognize under Indian GAAP, right? I hope the concept of deferred tax and deductible liabilities must be clear to you guys. Okay, let's take one more example on the non-deductible liability. For example, fine and penalties, right? If there is a fine and penalties, it will never be allowed as a deduction. It will be a permanent disallowance under tax. So what will happen? Should I create a deferred tax on that? Answer is no. I am not supposed to create a deferred tax on that, right? So the temporary difference should be 0, and in order to have the temporary difference 0, the tax base should be 1 lakh rupees. Correct, guys? Okay. Repayment of loan, non-deductible liability. If I am repaying the loan, what is the book base? The carrying value will become the book base. And what is the tax base? The same carrying value will become the tax base, because on the payment and the repayment of loan, there will be no deduction allowed under tax. Correct? Okay. Let's take one more example in respect of the items or in respect of the transaction which has tax base but there is no book base. What can be the example? The best example which we can think of, like pre-incorporation expense. So what happens in the pre-incorporation expense? We recognize the pre-incorporation expense as an expense in the P&L in the same year in which it has been incurred under Ind AS, but it will be allowed as deduction under tax over the period of 5 years. So therefore, this creates a difference or a temporary difference between the books and tax. Let's see how it happens. So A Limited has been incorporated very recently. It incurred 1 lakh rupees on its incorporation. It has been charged to income statement in the very first accounting period. The taxation law allows deduction over the period of 5 years, right? The carrying value at the end of year 1 is nil under books, and how the deferred tax needs to be recognized. So what will happen at the end of first year? Book base is 0, tax base is 80,000 rupees, because 20,000 rupees is allowed as a deduction under tax, right? So temporary difference will become 80,000 rupees. So I need to compute, or this company has to compute, a deferred tax on this 80,000 rupees, right? Similarly, in the second year, book base remains the same, 0, but the tax base becomes 60,000 rupees, because 20,000 rupees will again be allowed as a deduction under tax. So there is a temporary difference of 60,000. That means initially in the first year, the company will create a deferred tax on 80,000 rupees, and subsequently the company will create a deferred tax on 60,000 rupees. That means the company, or virtually the company, will reverse a deferred tax on 20,000 rupees in the year 2. Correct? And this matter will keep on moving on till the end of year 5. Again, at the end of third year, book base is 0, and 20,000 rupees will be allowed as a deduction under tax. So the balance or the carrying value under tax becomes 40,000 rupees. And now the company has to create a deferred tax on this 40,000 rupees, or I can say company will reverse 20 deferred tax on this 20,000 rupees. And similarly so on in the year 4, and similarly so on in the year 5. This is how the concept of deferred tax operates over a period, guys. Correct? I hope the concept of this deferred tax must be clear to you. Right? Now the question arises, sir, when we need to create a deferred tax asset, when we need to create a deferred tax liability, I have personally faced, or I have personally seen lots of people who are facing or struggling in respect of understanding when I am supposed to create a DTA or when I am supposed to create a DTL. The concept is very simple, which is coming from Indian GAAP. The benefit which I am getting in tax in the future, today I am supposed to create a deferred tax asset, right? And the liability and the obligation which I need to make or which I need to manage in the future on account of taxes, I need to create a deferred tax liability. Correct? Right? So if I look at the asset side, if the book base, that means the carrying value is higher than the tax base, so I am supposed to create a deferred tax liability. So that means if the PPE value as per books is 100 rupees and as per tax is 80 rupees, so I'm supposed to create a deferred tax liability on 20 rupees, right? Similarly, if you do the reversal of this concept, if the book value of the asset is lower than the tax base, it will result into the deferred tax asset, right? And if I look at the liability side, if the book base is higher than the tax base, for example, I have allowed a provision for gratuity of rupees 100 in books, but under tax I have not provided any deduction because it gets disallowed. So that means the book base is higher under tax, but I will get the benefit in the future, so I am supposed to create a deferred tax in my books of accounts. Similarly, just a replica of this, if the liability, in case of liability, if the carrying value is lower, if the carrying value which is lower than the tax base, then it results into a deferred tax liability, right? And if you need to if you need to think or keep memorize all these things, it's very simple. Just remember, for the perspective of asset, if the book base is higher, then it results into a liability, and do the reversal in respect of any other item, right? That is the concept and that is the base for recognizing deferred tax asset and deferred tax liability. Correct, guys? Let me move on quickly since we are having a limited time today. Okay, so these are the various steps which we need to follow. For example, I need to compute the carrying value of assets and liabilities. I need to compute the tax base. I need to compute the temporary difference. I need to see whether the temporary difference is deductible or taxable. Then I need to determine the tax rate. Then I need to compute the deferred tax. And finally, I need to recognize the deferred tax in my books of accounts by passing the accounting journal entries. And I need to see if there are certain items on which I am having a deferred tax asset and certain items on which I am having a deferred tax liability. Then I need to see whether this needs to be offset or whether this needs to be recognized separately, right? Okay, small case study. So this is the entire scenario which the company should be having while designing their deferred tax methodology for computation. Asset side or liability side, then the book base, tax base, temporary difference. Then I will compute deferred tax, and then I will evaluate whether it is a deferred tax asset or a deferred tax liability, right? So if I look at property, plant and equipment, 7,000 is the tax books base, 5,000 is the tax base, 2,000 will be a temporary difference, and multiply by 30%, I will get deferred tax. And since the book base is more than the tax base, this will result into a DTL, deferred tax liability. And what is the reason between the temporary difference? It could be multiple reasons. For example, different depreciation rate and section 43A implication. Under Ind AS, foreign currency exchange gain is not allowed to be capitalized, but under tax, it is allowed to be capitalized as per section 43A, right? ROU asset. ROU asset, for example, 5,000. Book base is 5,000 rupees, tax base is 0. Why 0? Because this is a new standard which has come up under Ind AS. Ind AS 116 last year, 1st April 2019, right? In which the lessee accounting in case of operating lease has gone away, and now we have to do the finance lease accounting in case of lessee as well. But under tax, nothing has changed. Under tax, nothing has changed. The company will continue to claim the rental expense, That means whatever accounting company will do, it has nothing to do with tax. Tax will continue as we were doing in the earlier years. So there will be no tax base of this ROU asset. So this resulted into a temporary difference and therefore a DTL, because the book base is higher than tax base. Intangible, generally there is no difference. CWIP, generally there is no difference. Goodwill, it depends. If goodwill is tax deductible or goodwill is not a tax deductible. If goodwill is tax deductible, then we need to compute a deferred tax on that. Under Ind AS, what happens in respect of goodwill, we don't amortize the goodwill, right? Goodwill will always be tested for the impairment, right? But under tax, if it is a tax deductible, goodwill will be amortized maybe over the period of 5 years, right? So this will create a temporary difference, and how this temporary difference will get reversed when that goodwill get impaired in the future in the books, this temporary difference will get reversed, right? Long-term investment, this also resulted into a temporary difference because under books fair valuation is allowed, but under tax we are supposed to do the indexation of those assets, right? So it will create a difference in the value of investment in both the books. Trade receivable, generally no difference. Inventory, cash and bank, short-term investment, generally no difference, hence no deferred tax to be created. Deferred asset, prepaid rent. Again, the deferred tax needs to be created because the accounting, due to the implication of Ind AS 116, has got changed. Now the prepaid rent will form a part of ROU asset, right? Then I come to the deferred tax liability or a liability side. Borrowings, it may create a difference between the tax and book base because under books or under Ind AS, as per Ind AS 109, if there is any transaction cost, that needs to be adjusted from the borrowing itself, right guys? So it will create a temporary difference. Trade payable, generally there is no difference in the trade payable. Provision for gratuity, leave encashment, right? So this will get disallowed and it will be allowed only on the actual payment basis, correct? So this will create a deferred tax. If I talk about the warranty, generally there is no difference in the tax and books, hence no deferred tax. Provision for doubtful receivable, some companies will disallow the provision for receivable under tax, right? So it will create a temporary difference and therefore deferred tax is supposed to be recognized. And finally, for example, the lease liability, right? In which this is arising from Ind AS 116, this will not allowed or there will be no tax base under tax, and this results into a deferred tax as well, because tax will continue in respect of the rent allowance. There is no concept of the lease liability and ROU asset under tax, which we have under books on account of Ind AS 116. Right guys, so this is the broad parameter which I have tried to capture in couple of these slides for large number of items which we have or which we generally see in the different companies across the globe, right? Okay, let me move quickly guys. Offsetting principles. So can we offset the assets and liabilities? Ideally we cannot offset the assets and liabilities. Income and expenses we cannot offset, otherwise what will happen, we only have the retained earning and nothing else in the balance sheet and nothing else in the P&L. So first of all, assets and liabilities are not supposed to be netted off, but there are certain assets and liabilities which are supposed to be netted off, and that will be required by different standards. For example, provision for doubtful debt, ECL provision. So 109 says it will be netted off from the debtors itself. Ind AS 2, provision for inventory obsolescence. Ind AS 2 says that it needs to be netted off from the inventory itself, right? Discounts. Ind AS 115 says that if you are providing any kind of discount to your customers or the customers, then it will be netted off from the revenue, right? So there are certain assets, there are certain liabilities which need to be netted off, there are certain income and expenses which needs to be netted off as per the requirement of the respective standard. Similarly, the question arises here, can we offset the deferred tax asset with the deferred tax liability? Answer is yes, because this has been given by the standard. So standard says that if the deferred tax asset and liability is legally enforceable right for the company to set off, right, then the company can net it off, right? If the deferred tax asset and liability relates to the income, or it relates to the income tax levied by the same income tax authority, then it can be netted off. So for example, i need to I need to pay tax, or I need to get the refund from the same income tax authority, so I have a legal enforceable right to set off. That is why it can be easily net off in Indian scenario. But the example which I've quoted earlier in the inception of the this session, that if the holding company is in India and one of the subsidiaries located in Australia and one subsidiary is located in US. So the DTA which is arising in the US subsidiary and the DTL which is arising in the Australian subsidiary cannot be offset, because there is no enforceable right to set off, and there are two different taxation authority. So the holding company in its consolidated books of accounts is supposed to recognize deferred tax asset in the asset side and deferred tax liability in the liability side. Right, guys? Okay. Compound financial instrument. So compound financial instrument, this is coming from Index 32, right? So if there is a compound financial instrument, we should first understand what is compound. A mixture of two or more element is a compound actually. So when I combine this word compound with a financial instrument, it means for a one party it is a financial asset, and for another party it is a financial liability as well as equity. For example, what could be the example? Convertible, let's say convertible bond, convertible debenture, where fixed to fixed criteria is met, right? So in that case, what happens? On the initial day, I will create a deferred tax and that deferred tax will be recognized in equity. For example, I have issued 10% debenture, right? And it is a compound financial instrument. So what will happen? I need to recognize the value of the debenture at a present value of the future liability. So let's say that comes out to be 7,50,000 rupees, and the tax base is 10 lakh rupees, which is the actual proceed. This create a temporary difference, and on that temporary difference, I will create a deferred tax liability, right? And that deferred tax liability will be routed through equity, right? But the reversal of that deferred tax will be routed through P&L in the future, right? So this is one of the complex part on compound financial instrument. So due to the paucity of time, guys, I will move directly in respect of the gap difference between uh, Indian gap and Ind AS. Okay, first is approach. So under Ind AS, we follow the balance sheet approach. Balance sheet approach means that we have to compute a deferred tax based on the numbers which is appearing in the balance sheet, which we call as a carrying value or a book base. And similarly, we need to compute the tax base as per the tax numbers, right? But under Indian GAAP, we follow income approach. Income approach means we compare P&L of books and we compare the P&L of tax. And whatever the items as a coming as a reconciling item, we will further classify as a permanent difference or a timing difference, right? So this is a big difference between Indian GAAP and Ind AS for the computation of deferred tax perspective, right? Second is recognition of tax in P&L or OCI or equity, right? Under Ind AS we have P&L, under Ind AS we have OCI, and under Ind AS we have equity as well. And there are items which get recognized in P&L, there are items which gets recognized in OCI, and there are items which get recognized in equity, for example compound financial instrument, right? So where the item goes, the tax effect or deferred tax or income tax will be recognized in the respective statement. But we don't have the similar concept under Indian GAAP. We don't have OCI under Indian GAAP. We don't have any items which get directly recognized in equity instead of P&L, right? So there is no concept of recognition of deferred tax on those items in the OCI and equity under Indian GAAP. So this is another big difference between the Indian GAAP and Ind AS. The third one is the dual tax rate. So in Indian GAAP, we have to follow the single tax rate which the company is following under tax. But under Ind AS, we have to take that tax rate which is going to be taxable, which is going to be deductible in the future. If there is a capital asset, if there is a long-term asset, and the tax rate may be 10% or 20% in the future, then the company has to use that tax rate for the purpose of computing deferred tax. So that means the manner of recovery of the tax in the future shall be consistent with the recognition of deferred tax. The fourth one is the MAT credit. under Indian GAAP, the MAT credit will be recognized as a part of the loans and advances. It will not a part of the deferred tax. But under Ind AS, this MAT credit will form a part of deferred tax. Okay, deferred tax on the consolidation and deferred tax on the unrealized profit. So these 2 points are correlated with each other. First of all, if let's say there is a company in India having a multiple subsidiaries, right? So how the company will pay tax? Tax will be computed at the standalone legal entity level, right? So whatever the tax the company will compute at the legal entity level, that will be recognized as a income tax, and accordingly, company will compute the deferred tax. Right? When the company will go for the consolidation under Indian GAAP, the individual tax expense and the individual deferred tax expense or income which have recognized in the legal entity will get summarized, and the company will recognize that summarized numbers in the consol financial statement. Right? So it may possible that the consol level company is having a loss before tax, but the company again recognizes income tax expense. Right? This is how the concept of deferred tax operates in case of consolidation or consol financial statement, right? But under Ind AS or IFRS says that company is supposed to recognize a deferred tax, or company is supposed to recompute the deferred tax at the consol level, right? That means company is supposed to recognize the deferred tax at the consol level. That means what is the difference between the standalone and consol? Company is supposed to create a deferred tax on the unrealized intergroup transaction as well, right? Because under Indian GAAP, intra-group profits, intercompany elimination transaction, no deferred tax is to be created. But when the company will create a deferred tax under Ind AS, so in deferred tax in respect of the intercompany elimination and intergroup profits, unrealized intergroup profits, deferred tax is supposed to be created, because we need to compute a deferred tax on the final balances which is appearing on the balance sheet. That is why the book base and tax base versus income approach will create a significant difference from Indian GAAP to Ind AS. Virtual versus reasonable certainty. Under Indian GAAP, we have the concept of virtual certainty supported by convincing evidence. The concept is, what is virtual certainty? Question arises. It means it does not mean actually a foreseeable profit. It does not mean the business projection. It means the company should have the profitable binding agreement, right? Cancellation of which results into a significant penalty. That is what the virtual certainty. But that concept does not exist under Ind AS. There is a reasonable certainty, that means projections, that means foreseeable profits, on the basis of which we will create a deferred tax under Ind AS. The last point is disclosure requirement. Ind AS requires a significant disclosures in the financial statement, but as compared to Ind AS, Indian GAAP does not require so much of disclosures. Some disclosures are required, but that is not at that large level which has been required by Ind AS 12. Right, guys? So I hope you have got some sort of clarity in respect of deferred tax, income tax, deferred tax asset, deferred tax liability, and some related issues. Right? Thank you very much, guys, for your patience. And now I will hand over the session to Mr. CA Praveen Kumar, sir.
Thank you, Amit, sir. Thanks a lot. The session was very enriching. And now I welcome Praveen Kumar, sir.
Thank you, ma'am.
Amit.
Thank you, ma'am.
Thanks.
So thank you so much, and welcome on this webinar on Indian accounting standards, which we call Ind AS. So today on this session, we will be discussing on standard on employee benefits, which is Ind AS 19. So basically this standard deals with accounting and disclosures for employee benefits, and it is not applied on benefits to which Ind AS 102, which is for stock option plans of the employees and share-based payments. So those kind of issues are not dealt with in this particular standard. So primarily it is employee benefits which are being discussed in this standard. So we will be discussing about the recognition, about the measurement, and about the disclosure related to employee benefits in this particular standard. We will also discuss differences of accounting standards as well as Ind AS as far as employee benefits are concerned. So we start directly with the objectives of this standard. Basically, when we prepare a financial statement of an entity, we look into the statement of affairs and we look into statement of profit and loss. This particular standards requires an entity or a company to recognize the liability in the statement of affairs and to recognize the expense. So liability is recognized when this company for which Ind AS is being applied, when employee of this company had provided service in exchange of employee benefits to be paid in future. So if a service has been provided by the employee and there is some exchange which is supposed to be in exchange of that service, company will be providing something, some benefit to the employee in the future. For that, there is a liability which is supposed to be created within this year, as well as when an entity consumes the economic benefit arising from services provided by the employee in exchange for employee benefits during the current period. So an employee is working for the company. So whatever company has paid for that service will be the expense of this year. Whatever the company will pay later on for the services which have been provided in this year is a liability. So this standard will deals with recognizing and measurement, recognition and measurement of both expenses as well as liability for the company in exchange of the service which has been given by an employee. So this benefit, employee benefit, can be direct benefit also, can be indirect benefit also. So the key takeaway from this session will be what are the type of employee benefits. We will look into whether it is short term, whether it is long term, whether it is post termination or post retirement benefits. We will look into all those areas. We will recognize what we will look into the policies, how this standard will be applicable, how to recognize and how to do measurement of such kind of liability as well as the expense. We will also look into what are the key differences between the accounting standards and Ind AS when we deal with employee benefits, and what are the disclosure requirements as per this standard. So we straight away go to the type of employee benefits. So the whole presentation will flow into these four parts. So in first part, we will deal with the short term. In the second part, we will deal with the post-employment employee benefits. Third part, we will deal with other long-term employee benefits. And fourth part, we will deal with termination benefit. So what are the short-term employee benefits which are expected to be settled within 12 months, within 1 year from the reporting period? Such as salaries and wages which have been paid, some allowances which have been paid. So those are treated as short-term employee benefits. There are certain benefits which are received by employees or given by the companies to employees after they retire. So for example, pension is given to employee after they retire, or some other benefits are given, which is post-employment. So for that, during the current year, the employee has rendered some services. So what is the quantum of that employee benefit which is supposed to be recorded in the books of accounts that is dealt with in this particular standard. So third is other long-term benefits of employees. So for example, there are paid leaves, there are disability benefits, which are long-term benefits which are given to employees when they are working in the organization, but they have not yet retired. And then once the employees have left the company, paid on termination as compensation. So that is the fourth part of employee benefit. So we will deal with each one of these separately, and we will try and explain with the help of examples and case studies how these employee benefits need to be accounted for. So first, let's look at the first bucket, which is the short-term employee benefits. As I had mentioned, that primarily it is the wages or the salaries which are being paid to the employees for the services which they have rendered in the current year. So in addition to the salary allowances and the wages which are being paid during the current year, there are certain annual leave and sick leave also being paid during current year itself. So these are short term, as I had mentioned, because they are supposed to be paid within 12 months, so within 1 year period. So that's why it is called short term. Then also there are some companies which do profit sharing with the employees, and they also give some kind of bonus to the employees. So that is also treated as short-term employee benefit. Then there are other benefits like which are a non-monetary benefit. For example, some employees are given cars, some employees are given medical care. For current employees, in some cases you may see that if an employee is working for an airlines, there are some tickets which are being given to employees for traveling. So those all benefits which are non-monetary benefits will also be covered when we are doing accounting as per Ind AS. So benefits can be direct, benefits can be indirect. So those all benefits are which are given during the year itself or within next 12 months. So they are basically treated as short-term employee benefits. So how do we do the measurement of the short term? So first is that we will not do discounting. So in case the company is applying Ind AS and there is because it is a substance-based accounting, the framework of Ind AS described that all the accounting will be done according to the substance. So if something is going to be paid after a long period, which is a long term, then discounted has to be done and fair value or a present value has to be calculated as on date. But for short term employee benefits, this discounting is not required. So these measurement for these benefits are on absolute basis. They are not on discounted basis. So these benefits are being paid in exchange of that service, and the amount has to be recognized as a liability after deducting any amount which has been paid, or as an expense if it does not form part of cost of an asset as per any other Ind AS. For example, in some cases, some benefits which are given to employees, and that is directly attributable to, let us say, property, plant and equipment or any, so they are being capitalized or they are added to a cost of asset as per requirement of other Ind AS. So other than that, this will be part of an expense of the year. So these are short-term employee benefits which are measured on undiscounted basis. The amount of short-term employee benefits, they are expected to be paid in exchange of service which is given by the employee to the company during this year. So these are the short-term employee benefits. Now, there are certain benefits which are, for example, some employees are absent from work, but still they are given salaries and they are being compensated. And there are certain rules as required by different regulations. So, employer or your company may compensate an employee regarding absence for various reasons. So it can be sickness, it can be festival, it can be holidays. So the employee is not working on those days, but still there is a compensation which is being given. So that is called short-term paid absences. And these amounts so these amounts which have been paid like this can be classified into two main categories. So one category is that accumulating. So these leaves are getting accumulated over a period of time, and there are certain leaves which are non-accumulative. So, for example, under Negotiable Instrument Acts, the bankers, if we take an example of a bank, so there are certain leaves which are casual leaves. They are not accumulating. So if an employee has not taken those casual leaves, so that employee, so those leaves will not be accumulated, will not go to the next year. It will lapse during the year itself. That's one kind of leave. The other is where, the earned leaves are there. So they are accumulating. The leaves are getting accumulated. They get accumulated to a certain extent. And then, so those are the two categories in which, the leaves can be, the paid entitlement can be classified. So accumulating and non-accumulating. So we will discuss how to do accounting of both. So casual leaves or non-accumulating leaves, they are recognized when the absences occur. So suppose a person has gone for a leave, which is a casual leave, and it is non-accumulating. So the leaves are elapsed. So whatever salary is being paid, it is being recognized at that point of time itself, because there is no additional compensation is being going to be paid for those leaves or those absences. Now the challenge comes when there is an accumulating paid absences. So it is recognized when the services are rendered, and with each time the service is rendered, the entitlement is increasing. So the future paid absences which are carried forward. So suppose there are earned leave of, let's say, for example, there are 20 earned leave in earned leave in this year, which are going to be carried forward and going to enhance, they will keep on accumulating. So how do we account for those kind of paid absences? So there are two ways. One is non-vesting. So that means if there is no cash entitlement, then it will be non-vesting. And if an employee is entitled to cash payment for unused entitlement, then it will be vesting. So we will discuss how to do accounting of vesting as well as non-vesting. But as far as non-accumulating is concerned, they are recognized immediately during the year itself when the absences occur. So if somebody has taken leave, it is out of the casual leave, though that person has not worked, but still that is being paid. So that paid absences is recognized as expense immediately. So let us look at this case study. A case study is, so let us say this company, the name of the company is L Limited. So if the company has got 100 employees, all of these employees are entitled to 10 working days of paid sick leave for each year. So unused sick leave may be carried forward for one financial year, and it can be utilized on last in and first out method. So let us say as on 31st March 2021, the average unused entitlement is 2 days per employee. And based on past experience, now in this case, the management will need to make an estimate. So you're closing your books of accounts as on 31st of March 2021, and there is an entitlement, maybe those unused leaves of 2 days per employee can be carried forward. So the management is having an estimate. Management expects that only 20% of the employees will be using 1 day leave from their carry forward leaves. Others will not use. So salary per day is, let us assume that for the purpose of this example, let us say it is 2,500. So now the question is, the amount of expenses, what will be the amount of expense in respect of short-term compensated absences if they are assumed to be vested short-term compensated absence, and number two, non-vested short-term compensated absence. So in case it is vested short-term compensated absence, the employee benefit will be 100 employees into 2 days and 2,500 per day. So that means 500,000. But in case non-vested short-term compensated absences, then the management estimate will come into play. The employee benefit expenses will be 100 employees into 20%, because the management estimates that only 20% of the employees will be using only 1 day. So 100 employees into 20% into 1 day into 2,500, which is the per day rate. So the expense will be 50,000. So basically, if you are doing the audit and the entity has applied Ind AS, then you will need to see what is the method through which they are calculating the employee benefit, which are short term. Now we go to the second bucket and we see how the recognition and measurement of employee benefit is done in case of post-employment benefits. So a person will get certain pensions, certain benefits after their employment. So this is one of the most critical area, and this would require a lot of estimation by the management. And as people who are doing audit, they will need to have an expert view on how the calculations have been done. So during the current year, during the year for which you are preparing or auditing the financial statements, you will need to understand how the measurement has been done for these post-employment benefit. So there are a number of employees working in the company. After the employee will retire, there will be some pension and some other benefits which they will receive. So different number of employees are going to retire in different years. Then there will be growth. How much will be the salary increase? So these all factors will be taken into account, and then comprehensive work will be done. So this is an area where you will need a support from actuary, and actuary will take a base of estimates made by the management. And this is one area where the people who are doing accounting need to be very careful, because when they are giving growth rate, that needs to be carefully understood. What growth is generally happening in the company in terms of salary enhancement or promotions. And also when you are doing an audit of an entity which is using Ind AS, you need to carefully see what estimates have been given to actuary for making these kind of estimates. On what grounds he has calculated the present value of the expenses which are supposed to be booked in the current year. So there are two type of post-employment benefits, broad category. One is defined contribution plan and the other is defined benefit plans. So you need to understand the difference between contribution plans and benefit plans very clearly, because in one case the risk is with the employee risk of return, and the other case, the risk of return is with the employer. So you need to very clearly, and we will discuss this part in upcoming slides, that what will be the benefit, employee benefit, which will be treated as contribution plan, and what will be the which are the employee benefits which will go into defined benefit plans. And in case of contribution, things are relatively simpler. But in case there are benefit plans, then there is a lot of uncertainty on part of the management, how much will be paid and how much will be, so the risk of that investment will also be with the management. So defined contribution plans include, let's say, pension, lump sum payments on retirement. So it is defined that how much will be contributed by the company for, let's say, provident fund. So let us assume that there is a rate of 12% as employer contribution towards the provident fund. So you know how much amount is going to go out of the company depending on the salary levels and the promotion levels of that employee. But it is defined. So it is defined contribution plan where company is going to contribute a specific amount. But benefits such as post-employment life insurance or medical care, so company is not sure how much money they might need to spend at the year end, after, and not at the year end, after that person has retired, or post-employment benefits. So there may be a situation that that person might not need the medical care, or the person after retirement will need a significant amount as medical care. So those are the benefits which the company is promising. In first case, the company is promising an amount. So it is very important for us to understand the difference between the contribution plans and defined benefit plans, because as a person who is preparing the financial statements, or as a person who is auditing these financial statements, both of these people need to be aware of what are the contribution plan, what is the difference between contribution plan and benefit plan. So let's discuss these differences. So in defined contribution plan, the obligation, so there is a legal or constructive obligation, but that obligation is limited to the amount that entities agree to contribute. So let us say there is a pension, or there is a provident fund. So the company has agreed that, okay, this much percent every month of the remuneration. So there is a limitation to this constructive obligation. Whereas in defined benefit plans, so the company has agreed to give benefit to the current and the former employees. Even the employees who have retired are still there. So they are also eligible for that defined benefit plan. So one is the obligation is limited to the amount which the company has. So this is the obligation. And in other case, the company's obligation is to provide the benefit. So it's not the amount. Amount is limited to this much percent, but the benefit, it can be quite uncertain. Then who is the second difference is who is the risk bearer. So the valuation is done. So the actuarial risk and investment risk, it falls on the employee in case of contribution plan. So the employee will keep on getting the interest which has been decided. So let us assume that we are talking about provident fund, and central government is deciding the rate on the rate of interest on that provident fund. Rate is more or rate is less. That risk is not company's in risk. That risk is with the employee. So if the government gives a high rate of return, high rate of interest, the employee gets benefit, because the fund, the amount which is there in the fund, the interest on that will belong to the employee. risk is not with the company in this particular case. However, actuarial risk and investment risk fall on the entity in case of benefit plans. So let us say the company say that, okay, I create a fund, and from this fund I will the company will provide Medicare facility to the employees, or in case any employee is not well, company will. So that amount may be significant, and risk whether this fund is sufficient enough or not, it is on the company or the entity which is implementing Ind AS and recording employee benefit. So these are post-employment benefits which we are talking about. The third is how to determine the amount of post-benefit. So you've got thousands of employees and they will keep on retiring at a particular age. So quite many chances are that some of the employees might leave much before that. Some of the employees may leave after that. So amount of post-employment benefit received by the employee is determined by amount of contribution which is being paid by an entity. So entity will know that I will give a particular percentage, so my contribution will be limited to this. So based on the estimates which the actuary will make, so the amount of contribution will be limited to the percentage of contribution by the company. So in case of benefit defined benefit plans, there's a predetermined or agreed post-employment benefits are received by the employee. So in this case, the employee will receive the contribution which is in terms of money, in terms of determined by the amount of contribution. In case of contribution plan, the amount is defined, predefined. It can be a percentage or it can be otherwise. But in case of benefits, it is the benefit which is predetermined. So it is the amount which is predetermined in case of contribution plan, and it is the benefit which is predetermined in the defined benefit plans. So one more difference, which is change in obligation. So if there is a contribution happening, so generally no change in contribution of an entity is made, except in certain extreme cases. However, in defined benefit plan, if actuarial or investment experiences are worse than expected, the entity's obligation may increase for providing to the employee. So today, if an entity is preparing the financial statements, general purpose financial statements, so management is making an estimate. So they are saying that, okay, total value of employee benefit, the salaries will be this much, my contribution will be this much. So generally the obligation remains constant. That company will keep on paying, for example, 12% of the wages and the salary. In case there is a change in regulation and they say no, you will need to include the allowances also. So or let's say the rate is changed by the regulator from 12% to 15% or 13%, then there will be a change in the obligation. Otherwise, in case of contribution plan, the obligation remain constant. In case of benefit plans, the employee obligation, so the companies, they will need to revisit their estimates. So their obligation may increase, because let us say if if there are significant increase in the premium which is being paid for medical support, so the obligations might change from year to year. The estimate might change. So in case of contribution plan, generally there are no change in the contribution, but in case of benefit plans, the changes will be more frequent. Let's put it like that. So let us understand this from another example. So let us say there is a company which is XYZ Limited. It pays to the employees a one-time benefit upon retirement, which is called long-term service reward. And this benefit is based on employees' years in service. So somebody who has worked for so many years, that employee will receive one-time service award. And its award will be based on the final salary prior to the retirement. So first, the actuarial estimate will be how much is the period and how much will be the salary growth, how much will be the promotion. All those estimates will be there. But so this benefit, so the question is, to cover the liability in this regard, company has created a fund, and that fund is called long-term service fund, and the company is contributing percentage of annual gross salary to the fund. So this fund is, so company has created a fund in which there is a contribution happening every year, but it will be given when the employee retires, and long-term service award will be given, which will be based on his number of years in service and final salary up prior to the retirement. So would this obligation represent a defined contribution plan or a defined benefit plan? So this particular case, it will be a defined benefit plan, because in the present case, the company has carried the risk. In case of funds, assets are not sufficient to cover remuneration in full. The company must bear the remaining amount. So who is having the risk in case this fund is not sufficient and there are so many employees who are retiring on that particular date, or the amount is much more? Then the company must bear the remaining amount. So the company's liability is not limited to the contribution which it has made to the fund, and is in obligation to pay the fixed amount irrespective of position of the fund. So you understand, in case company's liability is limited to the contribution, then it is a contribution fund. If company's liability is to give benefit, which can be more than the fund, then it can be it will be defined benefit plan. So in this particular case, because the company's liability is not limited to its contribution to the fund and is in obligation to pay the fixed amount irrespective of position of the fund, it will be treated as defined benefit plan. So how do we do determine the amount? So the report, how do we account for the amounts which are in defined contribution plans and defined benefit plans? The reporting entity's obligation for each period is determined by amount to be contributed. So we are now talking about contribution plan. So the amount is determined by the amount which is contributed. So no actuarial assumptions are required to measure the obligation or the expense, as there is no possibility of any actuarial gain or loss. Company will keep on contributing whatever percent is there, and obligations are measured on an undiscounted basis. However, there are certain exceptions. So in case the obligation falls due after 12 months, then the discounting is done. That is a principle which we follow in Ind AS. Now, when it is a defined benefit plan, which is the most complex part when we do the accounting, actuarial valuation and assumptions are required, because you want to do a measurement of the defined benefit plan. You want to do a measurement that after they will retire, so there is a benefit which will go. So there will be amount which will be estimated and the present value will be calculated. So reporting entity should provide for actuarial gain or loss, because in some year the estimate would give a different picture. The other year the gain, the actuarial report will give another picture. So gain or losses will be reported by the entity. So obligations are measured on a discounted basis. because they may be settled many years after the employees rendered the related service. During this year, employee has done the service. However, the benefit of this year's service is going to be given after, he will retire. That benefit he will get. We don't know the amount of that benefit, but it will be after many years. So the calculation will be done. So cost of defined benefit obligation is influenced by many variables, such as what will be the final salaries, what will be the employee turnover, he may leave in between, and mortality, etc. So all those variables will be part of the estimates. If you are doing an audit, please ensure that you have seen those numbers and those estimates and those variables which have been given to the actuary for calculation of estimates. Now, there can be a situation that the company may create a fund for those defined benefit plan. There may be a situation company has not created any fund. And there may be a situation that it can be the company might create a trust in which they will keep on funding. And that can be funded in full, or that can be funded in part. So how do we do the accounting? Because this defined benefit plan, there seems to be quite a lot of complexity. So there are 3 steps. So step 1, step 2, step 3, which are given in this Ind AS itself. So one is projected unit credit method. Then you will do discounting, and then fair value of planned assets. Then in step 2, you will do current service cost and past service cost, and you will calculate net interest. And step 3 will be, you will be calculating actuarial gain or loss, and you will return to the planned asset. You will also do accounting of return on the planned asset. So there are steps which have been defined. So step 1 is, like I had mentioned, determining the net defined benefit obligation. So you will need to have reliable estimate of fair value of defined benefit obligation. That amount, which is your reliable estimate, it represents the benefit that employee have earned in return of the service of the current year. Then estimate should be based on actuarial assumptions about, like I spoke about, various variables and financial variables. There can be demographic variables also. So example of demographic variable is like employee turnover and mortality, and financial variables such as future increases in salaries and medical cost. So the amount can be calculated using projected unit credit method, and then you will need to discount that benefit in order to determine the present value in the current service cost. So put it simply, employee has done service in this year. Because it has given the service to the company, in consideration, there are certain benefits which the employee will receive in future. There will be certain salary increase, there will be certain possibility of leaving the company or mortality rate, all those. So actuarial calculation and assumptions will be done, and present value will be calculated that, okay, how much is cost during the current year for that benefit. So that's the concept which is being used in Ind AS, because you will need to understand the present value and then fair value of any plan asset which is already there. You need to take care of that as well. Now, determining the amount to be recognized in profit and loss. One is the current service cost. The second is any past service cost, because there may be some benefits which employee earns after working for a particular number of years. So, and for those years also there will be a benefit in the future. So net interest on the if a fund is created or a liability is created, so the assets have been created. So in case there are certain assets, so you will need to determine the amounts. You will need to recognize in P&L, because if there is income, And there is, so the third step would be determining amount to be recognized in OCI, other comprehensive income. So actuarial gain and losses will go into OCI. So then we go to the third bucket, which is other long-term employee benefits. So these are, measured other long-term employee benefits. So the measurement of other long-term employee benefit is done according to this standard. What are these benefits? So suppose there is a long-term paid absences like earned leave or deferred remuneration. So you will keep on deducting amount and after some period you will give. So those are, so it's not usually subject to the same degree of uncertainty as the measurement of post-employment benefit. So these long-term benefits are not that complex. The measurement is not that complex. So unlike the accounting required for post-employment benefit, this method does not recognize remeasurement in other comprehensive income. So if you are earned leaves, you will accumulating, so it will be straightforward in comparison to the post-retirement. For long-term employee benefits, an entity shall recognize the net total of following amounts in profit and loss. It will not go to OCI, it will go to P&L, except to the extent that other standard requires. So other standards are saying something else. We will follow those standards, but otherwise, following will go in P&L. The service cost, the net interest on the defined benefit liability, which is an asset, and then remeasurement of net defined benefit liability, which is again an asset. So it will go into P&L. So now we look at the termination benefits. So termination benefits provided in exchange for termination of employee's employment. So if you terminate, so they are resulting from either entity decides to terminate an employee, or employee it takes a decision to accept VRS or such kind of situation happen. So they do not include the termination of employment either at the request of employee without entity's offer or as a result of mandatory retirement requirements. So basically, we are talking about VRS related benefits. So termination benefits, they are typically lump sum payments, but sometimes would also include enhancement of post-employment benefits, either indirectly through an employee benefit plan or directly. So salary until the end of a specified notice period if the employee renders no further service that provides economic benefit to the society. So termination benefits, they are recognized, so there is a liability which is recognized and expenses also which are being recognized. So the method will be earlier of these two, when entity can no longer withdraw the offer of the benefit, immediately you will need to recognize. Or when the entity recognizes cost for a restructuring, which is as per Ind AS 37, and involves the payment of terminate. So whichever is earlier, you will need to recognize the liability as well as expenses for the termination of the benefits. Now we look at, in the last couple of slides, we will look at the differences between AS and Ind AS, and then we will look into one more example to understand the difference. So in accounting standard, if there are actuarial gains and losses, they are immediately recognized in P&L account. Whereas in Ind AS, these actuarial gains and losses are recognized in OCI, which is other comprehensive income. So this is, in the previous session also, you looked at it, that there is a concept of OCI in Ind AS. And in AS, they are directly taken to P&L. So there are a lot of places where you will find that accounting standard requires you to take the expenses or gains into P&L directly, whereas in Ind AS, you will find that they are routed through OCI. So in case of termination benefits also, there are differences between accounting standards and Ind AS. So in accounting standards, which are older set of accounting standards, they are recognized as a liability. The termination benefits are recognized as a liability when meets the criteria for recognition provision under AS 29, which is provision for contingent liabilities and contingent assets. Whereas in Ind AS, they are recognized at earlier of the following dates. So whether the entity, as I had mentioned in my previous slide, so they are recognized at the earlier of the following dates, which are one, whether when the entity can no longer withdraw the offer, immediately they will need to recognize. And second is when the entity recognize cost of restructuring under Ind AS 37. So these termination benefits are going to be accounted for according to the guidance given in this particular Ind AS. Then there is accounting of constructive obligation. Employee benefit arising from constructive obligations are not covered in the previous accounting standards or the Indian account. So in Ind AS, employee benefits, they are arising, if they are arising from constructive obligation, they are covered in Ind AS guidance. So past service cost and curtailments, in the previous accounting standards, they are recognized as as follows. They are recognized as an expense on a straight line method over average period until the benefit become vested. And B, if the benefits are already vested, they are recognized as an expense immediately. However, in Ind AS, the past service cost, including curtailments, is recognized as an expense at earlier of the following date. So when the plan amendment or curtailment occurs immediately, or when the entity recognizes related restructuring cost of or terminate. So earlier of those, immediately, in Ind AS, you will need to recognize that. Now we look at this case study. So this will be the last example, of this presentation. So in financial year, let us say 2018-19, there is a company called XYZ. It reviewed an actuarial valuation for one of its pension plan, which revealed a huge surplus. So value of plan asset is more than the related liability. So they reduced the next 5-year annual contribution to balance the same. In the next year, actuary of company reports actuarial gain and losses of 20 lakh. So how will you advise the company? So how will this treatment of actuarial gains and losses will take place in Ind AS as well as AS? So there can be two situations. You are part of the team which is preparing the financial statements. How will you account for these actuarial gains and losses? Second part is you are doing audit of an entity which is applying Ind AS, and entity has done a treatment in a particular manner. You need to be aware of that what is the difference between treatment in accounting standards as well as treatment in Ind AS. So in Ind AS, as I had mentioned earlier, they should be recognized as remeasurement and will taken to OCI. In accounting standard, they will be taken into P&L. So basically this is a main difference between Ind AS and AS. If you are doing accounting and if you are preparing the financial statements, you need to be very careful while recognizing actuarial gains and losses. If you are doing an audit, you need to have a careful review of how the company has done the treatment, and you need to see, in case you are doing audit and the entity has applied Ind AS, you need to carefully see the working papers which have been created by the entity, and the approvals which have been given by the board of directors and the agreements between the employee and the employer, you need to see what are the benefits which the company is promising. So as you can see, the employee benefits can be short term, can be post retirement, can be long term, or can be, so there can be 4 buckets in which these benefits, employee benefits, can be categorized. So Ind AS gives you very clear guidance on how to do recognition, how to do measurement of these employee benefits. The employee benefits can be direct, it can be indirect. They can be direct, so there are a contribution where there are defined contribution plan, there are defined benefit plan. So you need to be careful while implementing Ind AS or while doing audit of an entity which is applying Ind AS while dealing with the employee benefits, because this is one area where there are a lot of management estimates are made and actuarial calculations are done. And trust me, if as an auditor you have not looked into the estimates which have been given to the actuarial. So for example, if a company is giving an estimate to an actuarial that, okay, every year we are going to give 20% hike to the people, this is our estimate, every year we will give 20% hike to the people. You can have a look at the past records and you can say, hey, come on, you have never given more than 7% or 10% hike in salary in last so many years. You are estimating that you will every year give 20% hike. So how is it justified? So you can always, and the moment you question those estimates, the moment those percentages are tweaked, the amount which is taken to the expense will be significant, high or low. So maximum difference of opinion, they arise from these estimates only. So my friends, these were few points which were related to Ind AS on employee benefits. So now I hand over to the institute staff to take care of the further proceedings. Thank you so much.
I, on behalf of Accounting Standards Board, thank you so much, Parveen sir, for taking this session. I hope the participants have enjoyed, and it would definitely add on value for their knowledge on Ind AS. Thank you so much, sir.
Thank you.